Now, Jed Dorsheimer, William Blair analyst, joins us now. He has a market perform rating on Tesla. Jed, what did you make of the bottom line here, and what do you think it does for investors' confidence and willingness to keep funding autonomous and robots?
I'm still laughing by the hanky-panky thing, but anyways, I think on Tesla, this was kind of, this was not a salacious quarter for Tesla. I think, on the positive side, Elon called out our thesis, around energy storage, and this is like the, that kid's book, The Little Engine That Could. It's 15% of the business, but 25% of the profits, which is going to be a nice filler to auto, which is probably going to face some headwinds. The stock, as you asked the question, is still anchored largely around autonomy. And there you got a lot of breadcrumbs around, FSD, removal of the safety driver in Austin by the end of the year, and then expanding the market. So I think the longs are going to look and hang on that, which is most of the valuation, in our opinion, is based on. And then the auto, not a lot of surprises. Oh, one surprise for us, auto was better than expected on the profitability. With the tax credits, we expected those regulatory credits to go away, and they did stay. So we want to get some more clarity around that. We didn't. We have a follow-up with the company in a few hours, actually. Do you hope to get more details?
Yeah. Do you feel like these numbers were distorted in any way? Maybe perhaps some pull forward in anticipation of those tax credits expiring, and how does that challenge your ability to model the few quarters that we have coming up?
Sure. So there's two different tax credits. One, the 7,500, those are gone. And that did create a vacuum. So we saw a lot of demand this quarter, just under 500,000 units. We expect that unit number to drop off. We're at 400,000 for this quarter. But there's also the regulatory credits, and the Trump administration took the fines basically away. So that's a feckless fine if you don't meet that, where GM or Stellantis is buying these credits from Tesla. That business remained. It only dropped about 5%, and I'm not really sure why that is. So if that stays, that's going to be good. It's about 200 basis points of margin that could boost. If it goes away, which is what we're expecting, then that puts, that's where the energy storage business becomes much more important, is he's helping deal with the energy problems and the pain at the pump that people are experiencing, pain at the plug that people are experiencing around electricity prices with that energy storage to offset auto.
Yeah, I know the energy storage business has been kind of this sub-story that's been performing pretty well in terms of the growth rates and the share of profitability. Just how fast can it scale to become more representative in the implied valuation for Tesla, right? It's like 10, 12, maybe 12% of the revenue right now. And I just wonder if that's something where you can kind of point to it as a longer term growth opportunity. But at $1.5 trillion market cap, it just doesn't seem like it's moving the needle beyond the hopes for robotics and a lot of the other more distant stuff.
You're exactly right. So it's not going to replace autonomy. Autonomy is the driver for Tesla and the future for Tesla. So that is really key. I'm just saying that that's a small business that's going to help out in terms of profitability. In a frothy market like we're in, then the future opportunity in the development of Optimus and Robotaxi, that's going to have much greater weighting. If we say, if the market turns, then people are going to focus a lot more. Investors are likely to focus more on cash flows, et cetera. And so that's where the energy storage can help out a bit, but it's not going to replace autonomy. That is still the driver of the stock. In fact, we think it's worth, $300 of the stock's value is just based around that autonomy.